Hey there, I'm Pete Townsend, and this is Money Never Sleeps. We look inside the minds of entrepreneurs and at the crossover of startups, enterprise, finance, technology, and life as we know it. This week, I'm thrilled to welcome back Brian McDonald, a partner at Bay Advisory, a corporate finance firm helping founders navigate the complex journey of funding, scaling, and exiting their businesses. Brian first joined us back in 2021, and his insights have left a lasting impression, not only on our audience, but also on how I approach working with founders myself. In this episode, we revisit 6 key takeaways from our earlier conversation about aligning expectations, understanding valuations, preparing for exits, and the delicate dance between buyers and sellers. But this time, we take it even further, exploring how the market has evolved since then, the emerging challenges founders face, and the strategic mindset they need to succeed. From the art of staying true to your business's core identity, navigating valuation challenges in today's fluctuating market, and why it's important to know your no in deal negotiations, Brian dives deep with actionable advice and real-world examples. We also chat about Brian's passion for the Irish language, the delicate balance of running a business while pursuing growth opportunities, and the critical mindset that every entrepreneur can adopt to succeed. So whether you're just starting your entrepreneurial journey, considering a funding round, or planning for an exit, this episode is packed with invaluable insights you won't want to miss. All right here on Money Never Sleeps. So Brian, listen, in the spirit of starting with the end in mind, which I know is one of your ethos here to how you advise founders, back in 2021, the last question I asked, when I asked you what's one thing people wouldn't expect to know about you, you told me about taking classes to pick up where you left off with learning the Irish language. And that was wonderful to hear, but that was 4 years ago. How did that go?
First of all, thank you for having me on. To think that it's been 4 years is a bit crazy in terms of everything that's happened in the world since then. But look, like everything else, it's one of those things that I'm personally passionate about. So I take opportunities wherever I can to speak it. I speak it with my kids whenever I can, although they're kind of a good bit less enthusiastic. My eldest son just did his junior cert and he got a very good grade in Irish, which I was kind of shocked by, but he got, kind of top 2 or 3%. I was very happy with that, despite the fact that he refuses to give me any credit and he never speaks back to me in Irish, but it's still a big passion of mine and I'm hoping to keep it up. I went to university in France, so I've been doing a bit more maybe in French than I have in Irish, which if I'm honest with myself, French is probably a more useful language to actually have.
Perhaps. But listen, thinking back to our conversation in 2021, this was packed with insights. And it's one that I go back and listen to, and that it's really helpful when it comes to thinking about how I talk to founders. And I've said this to you before, that one of the founders that I worked with a couple of years ago, he said the most helpful thing that I said to him out of everything was something that I got from you, which was saying to the founder, hey, what is it that you really want, right? So this one we originally did 4 years ago. I think it's a perennial type of episode, and we'll put it in the show notes so people can go back to listen to it. But I thought with that conversation, we talked a lot about the delicate dance between sellers and buyers of startups or of small to medium-sized enterprise, and the importance of aligned expectations, the challenges of valuations. So for the founders that are just beginning their journey, or for those that are thinking about an exit, understanding all of these dynamics early on can make all the difference. Start with the end in mind, right? Like I said at the beginning. So I thought it'd be a good idea to recap the 6 key takeaways that we had from our conversation in 2021 and have you share your insights on what's changed since then. It's been 4 years. A lot of water is under the bridge. We got through COVID. There's all different types of changes happening in the world.
Yeah. Look, I think a lot has changed, but I suppose some of the fundamentals, Pete, have remained the same. And when I think about founders and aligning expectations with investors, I always go back to a lot of our clients, as you know, are SaaS, are software-based businesses, but many are not. And the biggest thing we say to our clients is that if you're looking for an investor, make sure that you're clear in terms of what type of company you are. Because far too often I see really nice businesses that seem to have this perception that they can convince the investor community that they are something that they're not. And they almost feel this kind of obligation to convince an investor that they're a SaaS business, for example. And not only are they a SaaS business, but they're more of a B2B SaaS business than a B2C SaaS business. Because certainly in the investor community in Ireland, B2B SaaS is kind of where everybody wants to get to at the moment. And that's because the funding market is difficult. Funding market is difficult at the moment. Fundamentally, I tell my clients is that I look at some ed tech businesses that are really beautiful ed tech. We do a lot of work in ed tech. But ed tech fundamentally isn't real SaaS. And when I say real SaaS, it isn't your classic Microsoft Office type product. And that's okay, because you can have really good ed tech business and you have really good ed tech investors. And they're the people you should be talking to. What I don't like my clients saying, but look, I think we can try and SaaSify this. And I think we can convince the investor that it's more like SaaS. Founders need to be really careful in terms of focusing on doing the right thing for the business and then selling that vision to an investor, rather than trying to second guess what they think they need to do for an investor. I think that's a really kind of important element here, Pete, when we talk about this alignment between founders and investors. It's just really important to do the business first and then selling that the real business to an investor.
Yeah.
That's where alignment is at the very start.
Yeah. And it's good to know what you are and to be grounded in that, and that there's always just one version of the truth, which is how you talk to your team about your business, how you talk to your friends and family about your business. You should be talking to investors in the same way.
Correct.
Obviously, there's a filter that you apply.
Of course.
But you don't change the story completely, because eventually that will fall apart. Right. So
yeah, I think that's a crucial point, Pete.
One of the other things you said is that if you plan to keep the business for life, avoid taking on investors who expect a return.
Yeah, I think if you're planning to keep in your business until, and we see some of this, technology businesses, we do quite a bit of work in the IT services space as well, which is slightly different. So we talk about managed services providers, those types. We do quite a lot of work in that space. And again, you're seeing a little less now because the funding market has gone, but we do see some of these MSPs saying, well, look, we should be valuing our business based on revenue. We go, when you're not really a business that's valued on revenue, because you're a services business, you're valued really on your margins, your EBITDA. Those businesses can still get investment. Of course they can, services business, but you need to be clear with the investor that this is a journey that's going to be a longer journey. I have no intention of selling this within the next 10 years. Now, beyond 10 years or beyond 5 years, who knows what we're going to do, I think at that point. And, there's plenty of ways we can structure things that allow investors for an option at a point in time to exit. So there's ways and means we can say, look, after 5 years, most shareholder agreements will allow that sort of optionality for one party to buy out the other and to have a handshake. So, it's not as though it's impossible, but I think the overarching point, Pete, is that we need to make sure that the investor is clear. If you're building a services business in the technology space, that this is a business that you intend to be in for 10 years, for 5 years, or actually, you know what? I'm going to be in this business for life, Yeah. I think about my own business, the services business. We don't have investors, but Berry Advisory, we're very clear that we're not really exiting anytime soon. This is a business we're going to run. I'm in my 40s. I'd be surprised if in 10 years' time, I'm not still advising early stage software businesses on funding and exits.
Yeah, I know. I feel the same. Like my wife asked me, Pete, what if one of these, 35 investments you've made hits? And overnight, boom. I said, well, you know what? I'll probably wake up in the morning and I'll still be working with founders. I just can't get away with it.
I think that's where I want to be in life, where I love what I'm doing. I love my clients. Sure, clients can be tricky, but I love what I do. And I think that's a key part of.
Yeah. I think that really comes out in the second point, which is consider alternatives to full exits. And what I said a few minutes ago about, hey, saying to founders, what is it that you really want to do here? And opening up their mind to say that there are other options versus a full exit, that selling the entire business, you don't need to go down that path whole hog. So
yeah, and we see when we talk to clients and they come into us, and the relief we see when we tell our clients, look, you don't have to exit here. we can get you a few quid off the table. Because a lot of people say, well, look, I've been building this business for 15 years. All of my wealth is tied up in this business. It's going really well, but if something goes wrong, that's it. And, I've got a mortgage, I've got kids, I've got college to think about, all those sort of things. And we say to them, well, look, what you could do here is you could sell 40% of your business. Of that 40%, you could invest half of it into growth, so you're doubling down, and 20% you take off the table. And that 20%, it may not be, life-changing, go live in the Maldives money, but it could be pay the mortgage off money. It could be college money. And that's what they want. They want that security, that, worst case scenario here, if everything goes to the wall, my mortgage is paid off and I've got the kids' college covered. And, knowing that those options exist is hugely important.
Totally. And even getting to that point where you could think about that requires valuations, right? We talked about that a little bit a couple of minutes ago, but that, like you said, the generic revenue multiples are often misleading. You got to look at comparable deals out there to be able to establish a fair and realistic valuation, especially in, like you said, complex fields such as SaaS.
Yeah, look, I think that still applies. One of the things we've seen recently, because of the way the market is that we've had clients who come to us and have said, look, 3 years ago, I was offered this. My business has doubled in that 3-year period. So therefore, I think it's worth double what it was worth 3 years ago. And a lot of the time you have to say, look at these last 10 transactions that have been done in the space, some of which we've done, and actually multiples are going down for a variety of reasons. What you have to tell them sometimes is, unfortunately, we think if you sell the business now, you'll get less than you would have got 3 years ago. And that's a very difficult pill to swallow for people.
Yeah, it is. They say that something is only worth what someone is willing to pay for it.
Correct.
But have they actually paid for it? So you got an offer 3 years ago. Anybody can make an offer. Did that actually see its way all the way through the deal phase of every single part of the deal?
It's worth remembering that throughout a transaction, there are areas where a transaction can fail. It happens all the time where executed term sheets do not end up with executed transactions. And that can be everything from, on the one hand, diligence failing. In other words, there's a diligence point that's a problem, to the buyer suddenly doesn't have the capital to execute the transaction, or the buyer's business has gone the wrong way and they're strategically asking themselves different questions during the process. It happens all the time. So the only comp really is a transaction that's being executed. I think it's very important, particularly when choosing an advisor, that the advisor is clear around valuation, their view on valuation. And for us, the lessons we've learned is that it's just really important that we are diligent around valuation before we start the process.
How often do you come across deals, whether you advise them or not, even if you just look at it, that says, well, here was our last valuation on our last round, and they're coming to you after they've already raised money, and it is you could see, yes, they did raise at a 25 million valuation in the past. So we need to be up from there, is, rather than actually just saying, well, we had an offer for it, we didn't follow through with it, but there was actually a round that closed at a specific valuation.
I suppose that we should differentiate here between kind of investment rounds and exits. Investment rounds, in some spaces at the moment, we're dealing with clauses in investment agreements that we hope you never have to deal with, which is the down round clauses and, the various investor protections around down rounds. And we're seeing at the moment situations where fintech is a good example of this, where valuations kind of post-COVID were, really high. And we're seeing more and more businesses that are coming to the market looking to raise again. And they're seeing that despite really good progress, again, valuation can be down, which is a very difficult place to be for the founder and for the investor. Investors usually have protections around down rounds in case valuations don't increase. But the difficulty with that is that if you're protecting the investors, then who are you diluting? You're diluting the founder. And then you can get into situations where the founder isn't motivated and doesn't hold enough of the cap table to drive the growth of the business. So you've got to be careful around that. And then there's various incentives you'll be able to put in place. So, a down round is a complicated space to be in. We're seeing more and more of those at the moment.
Yeah. I've seen situations where founders walk away with nothing, even with an acquisition, where they just, they get nothing because of the way the deal structure.
We pretty much exclusively advise founders and business owners. And that's a real piece that we have always pointed out that, look, don't gloss over the anti-dilution clauses. Don't gloss over the clauses around what happens when things go wrong, because unfortunately, things may go wrong. And, we often hear, to get a deal done, a party say, well, look, that's only in theory. We'd never enforce that anti-dilution clause, for example. But really, when push comes to shove in a negotiation, if they have the right to protect themselves, they almost always will.
Mm-hmm.
And founders are the ones that get squeezed.
They have to, because they have a requirement with their own investors that back them. It's wonderful to have these upfront conversations.
Absolutely. It's very important to trust your investor. I think you should also make sure that the document reflects the understanding directly, even if it feels like you're having to negotiate hard.
Yep. Always read the fine print.
Correct.
Absolutely. When you do have a deal in hand, preparing for earnouts, that was the fourth point, that few exits involve a complete walk away with 100% cash at closing. So many involve instead an earnout based on future performance metrics that can be quite complicated. So founders should aim for turnover-based earnouts rather than EBITDA-based, as EBITDA-based can be manipulated by the buyer. Right.
Yeah, I think that's similar to the previous point. I mean, earnouts are a feature of the market. Here in Europe, they're certainly very popular. Less so maybe in the US, based on of seller loans in the US more than they might have here. But here it's typically what we call an earnout. So that's where a chunk of the consideration is deferred. And an earnout can be a couple of things. We can talk about it. People kind of confuse sometimes deferred consideration and an earnout. When I talk about deferred consideration, I typically mean that consideration is paid irrespective of the performance of the business.
Mm-hmm.
Right. So when I talk about an earnout, usually it means it's directly linked to performance. And obviously these deferred considerations are very useful to buyers. Buyers really love them because it means that they can essentially pay for the business with the business. Because remember, if you have a 1 million EBITDA business that throws off cash of let's call it €1 million just for round numbers, and the deferred payment is say 2 million, that means that they can pay half of the deferred payment with the cash flow from the business. So that's a really attractive way for buyers to buy business, but it's less attractive for sellers, obviously. So, the first point of call is we don't want an earnout if you're a seller. The second point of call is to say, okay, it's not an earnout, it's just a deferred consideration. But then you're still reliant on the buyer rather to write the check, to actually ink the check after a year. And then the third point of call is an earnout linked to performance. And then if it's linked to performance, we'd always want it to be linked to turnover, because turnover is cleaner, easier to record. So we've got into very complicated discussions around if it's going to be an EBITDA earnout, well, then you have to exclude exceptional items. You have to do anything that looks a little bit like CapEx, but maybe isn't CapEx. You have to really work hard on the definition of EBITDA. So that's kind of one of the reasons that we're usually very focused on a turnover-based earnout. I think it's important to remember that the first port of call is no deferred payment. There's also a question, well, what's the total consideration? What does the rest of the deal look like as well? We very often talk about, a 30 million euro exit, but we don't talk about when that was paid. We don't talk about warranties. We don't talk about indemnities. We don't talk about issues a seller might have going forward. Is it really a clean exit if they're selling a business for 30 million and they have an indemnity to the buyer of 10 million? So an indemnity is where there's a clause in the documentation that says, if this event occurs, you've got to pay us back 10 million quid. There are details around business sales that are very important, but not linked directly to consideration.
Yeah. And that consideration can sometimes take different forms, whether it's 100% cash deal or 100% stock deal or a combination of the two.
I think that's right. And again, this gets back to the key point from the last conversation was know what you want. So if you want to exit, Pete, and you think, actually, I think there's a real future in this business and I want to sell my shares, but I want to keep working in the business, then you want to make sure you have some skin in the game. And having equity is really important, because you can drive the growth of that equity going forward. So you're really happy to have equity in the new business. But if you're looking to exit and do something else, actually having equity in the old business is a bit of a drag, because you have no control over its value. Very often you're a minority shareholder with very limited ability to exit. It
Yeah,
gets back to that point is what do you want? Who do you want to be? How do you see yourself in the next few years?
totally. Totally. Yeah, that is so critical. When you are actually engaged in this sale process, right? Staying focused on the business was one of the key takeaways as well, and how critical that is. And that the founder's focus should remain on business performance during the sale process, and that you start the beginning of a deal period with your EBITDA at one level, and then, then it dips or perhaps it goes up. And that I kind of equate this to fundraising at the earliest stages, where it's two jobs. You have a job to raise money, and you have a job to run your business. And when a founder's going through an exit, you got to run the business, but you also have to manage this whole deal process.
One of the biggest value destruction things that can happen during a process is that what we've told the investor. So this is whether it's an investor or whether it's a sale. If we told the investor or the buyer that we are going to perform in a certain way over the next year, and processes are taking longer and longer. So, and if over the 6 months since that forecast has been prepared, you significantly underperform, then a couple of things are going to happen. Either the buyer is going to get cold feet, and the buyer or the investor is going to say, actually, this is not for me because it's not what you told us it was going to be. Or they'll say, we still really like the business, but actually, because of the performance in the last 6 months, the valuation we put in the business is lower. Or else, which you see very often, because of the underperformance, we want a bigger deferred event to protect ourselves. The real key, and this is, this is one of the reasons why it's good to have an advisor on board, is that, let them look after the process. Let them look after the selling of the business or the getting of let them do the negotiations. Obviously check in and be clear where everything is, but you focus on driving the growth. Because the other side of it, what we're seeing at the moment, Pete, is that because of the market, and it's not a super space, things are taking a bit longer. Kind of anecdotally, we used to guide for a sell side process kind of 6 months from engagement to transaction. Now we guide, 12 months, 9 to 12 months. So there's been a big change in the last 3 years in terms of things getting done. It's much slower. It's not quite as bad as that for fundraising processes, but it can take much longer than expected. The longer the process, the more chance there is for something to go wrong, or for, a year is a long time if you're selling a business. It can sometimes take that long. And I think that's just really important that people are focused on driving the business. And because the corollary of that is that if the performance of the business improves and if you outshoot your projections, then there's a real pressure on the buyer to get this done. As an advisor, when we've done this before, we'd be talking to our clients saying, look, we need to get this deal done now, because if the buyer doesn't do this deal now, we need to think about whether we've undersold this business. Given the growth in the last 6 months, we need to think about whether we should be looking for a few quid more.
Yeah.
And that gives us really good leverage from a negotiating perspective. And look, I'm not speaking out of school here, because every investor, every buyer knows this. The best thing to get a deal done is for the business to be performing really well.
Time is critical when it comes to these deals.
Absolutely.
The buyer is sometimes looking at it saying, hey, the longer I drag this out, the more chance I might be able to get a better deal on it, and de-risking it at the same time for them.
Correct. Correct.
The last key takeaway was to know your no. What's your bottom line? Where do you walk away?
Very often there'll be a requested deal at the last minute from the buyer, and some of these are kind of benign, where they're looking to just make minor changes around the edges, and we can live with these changes. But some of them aren't, and most buyers are looking to get to the point where they feel as though they've got the best deal reasonably. They're looking to say, this is the best I could have done. I got this for the correct price, haven't overpaid for it. Buyers are petrified of overpaying for stuff, because then they don't get their return, kind of self-evidently. So sometimes the only way to get a deal done is to say no, and it's an absolute no. That, I won't move on this. And if you want to do this deal, you have to stick to what you said you're going to do. And that, knowing what that point is really important, because what a buyer is often playing on here is that you've gone through a process that you could be 10 months into a sales process here, and the request is a 10% reduction in price, let's say. And the buyer thinks, well, look, he spent so much time on this, a 10% reduction in price. He won't really care about this. But actually, the difficulty is that by giving that 10% reduction in price, you indicate that you're prepared to move on price. And therefore, the buyer immediately thinks there might be more to come here. So I need to keep pushing this. Once you get to a point where there's that sort of a material change, you really got to say no to it, particularly if there's no reason. That's where advisors come in and you say, look, I know this seems counterintuitive, but you need to be firm here. You need to be really clear that what's now being offered is not acceptable to you. And you need to be prepared to walk away. So it can't be a bluff, right? It cannot be. You have to be prepared to actually walk away from a bad deal.
And it can be gut wrenching.
And it is gut wrenching. Now, again, without getting into the weeds here, it's gut wrenching for everybody, right? For the advisor who doesn't get paid. A lot of our fee is based on success, so it's gut wrenching for everybody. But and we have to do this. We have to give that advice because it's crucial. But it's hard.
Crazy. It's crazy just thinking about this whole chain of everybody, right? And that you as an advisor to the founder, venture capital firms as holding a fiduciary responsibility to their investors that sit behind them, the company itself, where it's corporate buyer, and that they have responsibilities to their investors. And it's just, that's why this thing is so complicated. And we got to, like you're saying, you got to rise above it with, hey, what is it that you really want out of this?
I think that's where I constantly go back to take a step back here. If this deal doesn't get done, and this is the reassurance that we as advisors try to give people, look, if this deal doesn't get done, it's not the end of the world. We'll find another buyer. That's our job. We'll find another investor. Sure, there's been time wasted, but probably better to have that time wasted than to do a bad deal. Definitely better to have that time wasted than to do a bad deal.
And hopefully you can move more swiftly with the next one because you've done all that prep work in advance.
And the challenge I often get, listeners to this will be saying, well, look, do we really believe that Brian would give this advice when he's spent all this time and his fee is locked up on a deal getting done? From my perspective, we've done deals in the past where we've given this advice, and it was early in my Bay Advisory story where we gave this advice to one of our earliest clients, one of our biggest deals. That client, because we gave that advice, we did the deal 6 months later. Because we gave that advice, that client has been evangelizing around Ireland about how good we are. And he has sent us, I'd say, at least half a dozen clients in the last 3 years because we gave the advice to walk away from a deal that he knew that meant we weren't getting our fee. So that's why we do it as a shop, and that's why we do it all the time. Because if a deal isn't a good deal and you get a reputation as an advisor of doing shit deals, you're in a bad place. That's why, as an advisor, we do this and we give that sort of advice.
Yeah, trust is everything. When you are perhaps in that position where it is, let's walk away from this deal, obviously the founder's decision, but then you're perhaps looking at the next deal. You're in a situation where you've already got tons of documentation in place, tons of deal frameworks to consider and all of that, and that hopefully moving towards the next deal is going to be a little bit quicker than getting the first deal perhaps in place. But kind of trying to emulate that mindset a bit, Brian, when you're at the very beginning of the process, a potential deal will be in a better position if the business and the founder and the team are prepared to undertake a strategic acquisition. How can founders do just that, where they position their business for a strategic buyer before even going down the path of starting to look for buyers? What are some tips on how they can do that?
There's a few things that when you think about this, and it's a balance like everything else, in that on the one hand, it's important to be prepared for a potential process. But on the other hand, being constantly in fundraising mode or constantly in setting the business mode is not a very productive way and not a very efficient way of running the business. So So most of the time, particularly early stage businesses, we say, look, when you have some downtime, if you have some downtime, just spend half an hour on your data room. So first of all, if you've raised a seed round, you will have a data room of some sort. Even if it's just friends and family, you'll have some sort of a data depository. Spend a little time every now and then. No, not once every few months, just updating it. So maybe you're updating the management accounts and you're dropping them in. Maybe you're putting your new budget in there. Maybe you're putting your strategy. Just try and keep it so that you're not starting from zero for your Series A. So if you're going from seed to Series A, if you're fairly sure you're going to be raising the Series A, because data rooms are useful for, a lot of businesses we take from equity when they've raised enough equity or they don't want to dilute anymore, they move to debt. Having a data room that's kind of ready for debt providers is very useful too. Now it's a slightly different data room and there's different focus, but I think it's really important that you have that data room ready-ish. So I'm not suggesting that every day you're making sure the data room is precisely how you would like to share it with an investor. Don't do that. That's a waste of time. And also, typically when we get involved, we will spend quite a bit of time getting the data room neat and tidy and making sure that it's consistent, making sure that it's up to date, that it's messaged. But if you have this sort of documentation to hand, I think that's important. But I wouldn't advise a founder to be constantly fundraising mode. Now, the other side of that is that what is important, and I think it's clear that, is that you are talking to people in the investment community regularly, even if you're not fundraising. But when I think about talking, I'm thinking about a touching base, a call, a message, reaching out, letting them know you're there, that you exist. I don't want to do my Series B now or my Series A now, but look, I think I might be in a year's time. I think that's important. So it's a balance, Pete, between making sure that you're not constantly in fundraising mode, because that takes a lot of time from a founding team, versus knowing that you can shift into that mode relatively easily when you need to.
I talked to a founder recently about corporate innovation labs, and the corporate innovation labs have a requirement to have this watchtower in place to look out across the startup ecosystem, wherever they may be based.
Yes.
And just to keep themselves aligned with current trends. So the crazy idea was saying to a founder, listen, just go cozy up to 3, 4, 5 corporate innovation labs. Yeah. And you may then build those relationships, like you're saying, for a future exit, because corporates do obviously buy tech startups. Yes. And that is potential exit route. So keep your corporate innovation labs close. What are the differences in approaches when selling to a corporate buyer versus a private equity firm?
We sell to both at the moment. We sell businesses to corporates and we sell them to PE. And in some ways, there's quite a similar focus. So, the focus on the business, on numbers. Selling to a corporate, particularly a corporate who is in the industry or knows the space, the focus is typically slightly different. So a corporate will be quite focused on the industry. They already have a big start in terms of understanding the industry. So their questions around the industry, the space, the tech will be much more precise and they'll be much more detail orientated. Whereas a private equity house who will have some expertise, maybe it's a bolt on to an existing acquisition, maybe PE will pull in experts from other investment companies, but typically private equity, their first port of call will be understanding the financials and making sure that the financials that they see and the growth prospects hit a variety of tick boxes. Okay, whereas initially a corporate entity will be really just thinking about, well, how does this fit into my existing business, and how does that work? How will those businesses work together? Now, where it gets a little gray is that you often have private equity businesses that are kind of a buy and build strategy. So they may have 2 or 3 similar businesses in the space. So they will actually act a little bit more like a corporate buyer because they'll really delegate a lot of the work to their individual portfolio companies around the diligence, and the PE on top, the owner will, work on the financial thing. will provide the capital and work on the financial engineering of it. Private equity are also, and I think probably slightly more interested in the growth story, and they usually have an exit window, very clear exit window linked to the age of their fund. So most of them will be thinking about an exit after a period of time. I think that's
Yeah.
important to remember as well when you're selling to PE. Corporates will sometimes be prepared to make acquisitions that are strategically important from a technology perspective, but maybe not from a financial perspective. So the size of the deal may look tiny to a corporate, but then you might have this piece of technology that actually completes their tech stack. So sometimes we see when corporates are making an acquisition, Pete, we see them asking one of the early questions we get asked, well, how much have you spent on the tech so far? And what they're trying to do there, Pete, is they're trying to say, well, if I were to build this tech from scratch, how much would it cost me? And they're asking themselves the question, actually, how much would it cost me to build this tech from scratch? And they're saying, well, look, we'll pay that, around that number. Or that's kind of what they're starting to think is what's the cost investment here?
And that's where you get into acqui-hire conversations.
Yeah, I think that's right. There are obviously some significant differences between the approach. By the same token, when we talk to a client, we're usually pretty clear as to who the buyer is likely to be. And, oftentimes there'll be a mix of corporate and private equity. And maybe you're tweaking the IM for the different parties just so that you're kind of giving them the additional information. You're not changing the projections of the business plan. You're probably removing the introduction to the technology for the corporates who will probably know this already. You're getting straight into the detail. For the private equity, there might be a bit more education. Sometimes with private equity, there's a little bit more work up front so they understand the business first.
Oh yeah. I've seen sellers with like 6 different versions of their investment memorandum before.
Really, you got to be very careful with that as well.
You do because you don't know who's going to get what.
Trust is very important in these processes, and there's no point. An information memorandum is a sales document. It is, but by the same token, going through a sales process, there's a lot of trust required. If a buyer gets a hint that you are in any way being duplicitous or dishonest, it's death to a process. Absolute death to a process. So
definitely.
Again, we would never advise anything like that.
Be careful. Absolutely. Any emerging trends that you're seeing?
When we look at the market at the moment, and I'll talk in terms of tech because we do quite a lot of tech, like we're seeing valuations down in some sectors, and we're seeing, the characteristics of bubbles in other sectors. And look, I don't purport to be a technological expert myself, but I have a pretty good knowledge of a broad range of industries. From a services sector, we're seeing valuations really moderating around in the tech space. So, managed services, we're seeing a kind of a flattening out of valuations. On the other hand, we're seeing AI valuations really going through the roof. And there's an interesting kind of dichotomy between the public markets at the moment. I mean, in the public markets, you're seeing all of the big tech, the US tech, the NASDAQ going gangbusters. You're seeing, the NVIDIA doing extraordinarily well. And you're seeing the big valuations on these public quoted businesses. By the same token, that's not really pushing down into smaller technology businesses. And the other thing we're seeing at the moment is we think we're seeing a bit of a bubble in AI. And it's not that AI isn't game changing to our mind. It absolutely is. It's going to change the world. And again, there are smarter people than me who will talk to you about that. It will change the world. From a purely deal perspective, we are seeing businesses that are not AI pitching themselves as being AI. So we're seeing businesses that have a subscription to ChatGPT calling themselves an AI business.
Yeah.
No, look, I'm being a bit facetious here.
I know. No, I've seen the same.
But we're seeing that kind of those characteristics of a bubble, as though stamping your business AI, will give you a valuation lift, and maybe it will. Maybe that's the right thing to do, but that will fade over the next little while, and I think we'll start to see more maturity around AI and more kind of realism around the applications of AI. And some of this is similar to other trends we've seen in the past. The blockchain space very well, but back 4 years ago, 5 years ago, Pete, every deck we saw was blockchain enabled.
Yeah.
And now what we're seeing is actually when you see a business that has really properly understood that technology, that it can be really a game changer. But we see much fewer decks that talk about blockchain.
Wow. It's because I'm telling all of them to take the word blockchain out of their deck. Don't put it in there.
No.
Not because of negative connotations, just if you put it in there, it's a crutch, right?
Correct.
You shouldn't have to say it. You should be able to talk about your value prop.
That's really the point, that the technology just becomes a part of the value proposition. It's no longer the value proposition.
Yep, exactly.
AI can't be a value proposition. Blockchain can't be a value proposition. Your value proposition is something else. It's what you do. It's what you offer. It's what you're providing. But I think that's a really important point to make when we talk to our clients, is that if you have to say the word AI constantly through your deck, you need to go back and have a think.
Yep, totally. Any other trends that you think are important?
The other thing we're seeing more of from a deal perspective is we hope we're starting to see businesses realize that you don't have to be AI. You don't have to be SaaS. It's okay to be a services business with a tech element to it. And if that's what you are, then lean into that. If you decide, actually, I no longer want to do consulting, I just want to have a product, that's okay too. But if you are a consulting business that also has a technology element to it, then, that's what you are. Now, that people will say, well, look, doesn't that dilute value? Why, if you have the consulting wing attached, people will pay much less for a consulting business than they will for a SaaS business. Very many businesses we see require that interaction between the consultancy wing and the tech attached to it. To remove that doesn't make sense from a business perspective. Chasing valuation is usually a most game, because if you have a product that you think you can remove the consulting element and just sell it as a tech platform, you got to be really careful to make sure you can actually do that. We're seeing a bit more realism around that.
I absolutely love this stuff, Brian, and I could talk about it with you all day. Given that I asked you the last question at the beginning of this episode, Brian, I've come up with a new last question for you. Okay. So thinking about your whole baseline for how you're working with founders here, if you could instill one mindset or belief in every entrepreneur out there, what would it be and why?
I do a lot of reading around kind of personal development, and there's a book I've recently read, which is called The Slight Edge by Jeff Olson, US guy. It's really around doing the small things well. I often despair when I see founders with these great ideas and they come to me with a great idea, and maybe it's too early for me to get involved to help them. Then I see them in 6 months' time, and the great idea has become 200 great ideas. So they've expanded what they're going to do. They've got this huge, enormous ambition, and they're going to change the world. Whereas I look back and I say, God, 6 months ago, you had this lovely niche idea. I see a lot of my clients or potential clients, because they're usually, that's at that very early stage, they're maybe too small for us. But I say to them, well, what happened to that niche idea you have? And they said, well, look, we thought the total addressable market, global addressable market maybe wasn't good enough for me. So look, that TAM was only €1 billion. What? $1 billion? Yeah, we wanted to make that. And this is, again, in some ways, you see founders back solving their business for what they think investors want. So they have this perception that an investor wants this, and they back solve. Whereas the best businesses are just, this is my business, this is what I'm doing. And you know what? If this doesn't fit you as an investor, okay, I'll bootstrap. So I get back to that kind of slight edge, is that kind of focusing on the small stuff, becoming really, really niche and good at what you do. And I think that's the starting point for all business. So if I can get that mindset into people I see first, say, look, don't always be looking for this enormous market, this unicorn business. Start with your expertise. And you know what? If you get this niche right, and you get yourself to a business that has, let's call it 5 million of EBITDA, and you're worth 30 million quid, let's buy, in a few years' time, you can buy the other niches. You can buy expansion. But let's get that first niche right. So really focusing on that small thing, niche down rather than out.
You are speaking the truth, Brian McDonald. Thank you. And yes, find your product market fit and the money will follow. Like I said, this is something where these conversations and what you and I are talking through right now, Brian, are things that I absolutely love to talk about. So thank you for coming back onto the show to do this with me and to pick through and to kind of underscore all these highlights and takeaways and dig into some new ideas as well. So appreciate you doing this with me, and I'm looking forward to our next chat.
Great. Look, Pete, thank you for having me. It's always a pleasure. Hopefully it won't be 4 years.
It won't. And what's the best way for people to get in touch with you?
Email, which is brian@bayadvisory.ie. Always open to new discussions. And from our perspective, we're always open to ideas and thoughts, even if it's very early stuff. Come chat. It might be too early for us to take you on as a client, but we'll help you out. The other way is LinkedIn or bayadvisory.ie.
Wonderful. Looking forward to it. Thanks, Brian.
Thanks, Pete. Have a good one, mate.
That does it for this week, folks. Thanks to Brian McDonald for opening up his mind to help us figure out why he does what he does. Check out the show notes on moneyneversleeps.ie for all the relevant links to learn more about Brian and Bay Advisory. If you like what you heard, please leave us a rating and a review on Apple Podcasts and Spotify, easily accessed at moneyneversleeps.ie/rate. Also, thanks to Conan Brophy from Create Sound for mixing and editing this episode. Conan is an excellent media man to get in touch with when you're thinking about your own podcast. As for me, I'm an early-stage startup investor focused on where fintech meets crypto and crypto meets Web3, and I lead the Techstars Web3 Accelerator. There are plenty of links in the show notes on moneyneversleeps.ie on how to get in touch, so don't hesitate to reach out. Finally, till next time, thanks for listening. See ya!
Money never sleeps, pal.